Hey, Tom. Good to see you.
Hey, Kate.
How have you been?
Pretty good. Getting ready for spring. Flag football starting for my daughter and all the middle school aged kids in our town. So
very neat. And has she done that for a while?
Well, last year was last year was the first season for our town. We kicked it off. Great success. We actually won the championship. Not my team, but one of the other teams in town. And
that counts. That's a town victory.
Absolutely.
Yeah.
And this year, the player attendance, if you will, we grew it by 40%.
How neat.
Yeah.
How neat. And have the adults just allowed the children to play, or is there now an adult league? Because I feel like, sometimes, the adults watch the kids having so much fun and then they want in on the action. And then there's some pickup games happening on the weekends.
Yeah, there's more basketball, pickleball, and soccer for the adults where we are. But
all right, good.
I'm just trying to avoid injury. So coaching for me right now is not need.
I know that's kind of like after 40. It's like, every time you play a sport, you take a moment to pause, out of gratitude for not getting injured that afternoon.
Yeah, right. You got to take a deep breath.
Definitely. Yeah. Well, neat. So, yeah, and everything's, been good on my side, but we're moving and, we're moving down the street. And I don't know why I thought that would be easier because it's still packing up a house and there's still so many details involved, but exciting and all that. And I think staying in the neighborhood.
2.5 years ago, same town, just around the corner.
Yeah. And I guess it's still a lot of work. I think like a lot of the emotional stuff isn't as amplified just because, hey, we know the neighbors, we know the neighborhood, we know the school system, we know all that. Our doctors remain the same. So there's a lot that's staying the same for us. And from that perspective, it's easier. But it's still packing up a house and the logistics are still all there. So still a lot going on for sure. But yes, but so far so good. And thank you so much for our listeners for joining. We are Amplified Wealth According to Plan. And we are here today to talk about Section 121, the capital gains home sale exclusion when you're selling your house, which is front and center of my mind these days with the move coming up.
As it should be. So folks may not be familiar with the section of the code, but we want to get our listeners more familiar with Section 121. And thinking about how this may apply to their scenarios, right? As they think about potentially moving, which I know is housing right now is a big topic across the country, and so we thought that today we'd chat about this in a little more detail.
Yeah, and home prices have grown, right? Phenomenally so. Just since COVID. In a lot of areas. So a lot of individuals, when moving are faced with having had a market value that has rapidly increased. And, just to refresh everyone's memory, right, there's different types of assets that you can own. And the home, if you're using it as a primary residence, is a personal use property, right? So there's different tax treatment for the home than, say, a business asset, right? And you're not able, let's say you had a loss, which, many folks at this juncture, because home prices have risen so much, do not have losses in their homes. They're blessed to have gains. So even if you did have a loss and you sold your house, you couldn't realize a loss. You wouldn't get any benefit from taking that loss. But if you have a gain, normally with any property, there's that gain essentially between the selling price of the house and what you paid for it. The cost basis, and that gain would normally be taxable on, let's say, an investment. But there's this section 121 that allows, if you meet certain eligibility requirements, to exclude the first $250,000 of capital gains if you're filing single as a taxpayer, or $500,000 if you're married filing jointly of gains from the sale of your primary home. So this is a huge benefit because, normally you'd be faced with, potential capital gains when selling your house. So this is a great way for homeowners, to, I think almost it gives like a little flexibility, right? To be able to sell your house, to give you a little bit mobility and all that, to kind of be able to buffer some of that gain.
Yeah, I mean, it's a welcome exclusion to the capital gains rules for sure. And I think that, everything that you just described that you're going through, right? Getting ready to sell your house and move, even if it is staying in the same town, it still requires all the same work. But I think a lot of what sellers are tasked with is keeping track of not only, the price of where they're moving to, the moving costs, new furniture for the house and stuff like that. There's a lot of math that's involved, right? As you're kind of thinking through the decisions about, the pros and cons of moving and what it would mean for your cash flow moving forward, right? From the first house to the new house. And certainly making sure that you're buttoned up on the cost of the transaction itself is obviously a key part of the equation.
Yes, definitely. And so let's talk about, some of the eligibility requirements. And let's start off with kind of what would make you automatically disqualified from being able to participate, in this, potentially in the Section 121 benefit. So automatically what would disqualify you would be if, you've acquired the property through a Section 1031 exchange, which is essentially a kind exchange for usually investment, properties within the last 5 years. So if that was how you acquired the property within the last 5 years, you're not eligible to take advantage of this. And another point would be if you're subject to the expat tax, right, the expatriate tax. So now, if you're still like, okay, I might qualify for this, the biggies that you want to think about are this ownership and residence test. The ownership test is that you have owned the house as your primary residence for at least 2 of the last 5 years. If you are married, both spouses do not have to have owned the house, but at least one spouse has to have owned the house for 2 out of the last 5 years. And then the residence use test, you both have to have lived there. So if you're married filing jointly, you both have had to live there 2 out of the last 5 years, but they don't have to be consecutive years. So there's little nuances that, you want to make sure that you're paying attention to there.
Well, this gets to the essence of the exclusion, right? This is recognizing this as a asset that is being used by the owners, essentially as your primary residence, right? We can all wrap our heads around that concept. And there's always rules when it comes to, tax rules or exemptions from normal tax rules and things like that. So the ownership and the residence test piece of it, it's, when you think about it, it's not a overwhelming requirement here, especially in terms of the time requirement, 2 out of the last 5 years. If you think about ownership timeline for most homeowners out there, folks are typically not moving, over and over again and at a frequent rate, just because of the size of the cost of the home itself, right? Borrowing costs, transaction costs, all that stuff, getting settled in. If you have a family, you got to think about, kids and schools and things like that. So from a use test, in my opinion, not too cumbersome.
No, not at all. You're right. And, and I guess too, that where that little complication comes in, or at least that little nuance, if one spouse has owned it for 2 out of the 5 years, that kind of makes sense too. What if you're single, you buy a house, you get married, you live in the house for a couple of years together, and then sell it. I can see how, you got to just pay attention to those details. And then there's this look back as well, which, to your point, you can only use this exclusion once every 2 years. Right. So if you've taken this exclusion within the last 2 years, you're ineligible to take it again, which kind of makes sense because, you've had to use the property for 2 years.
Got to wait a little bit there. Yeah.
Again, just something to keep in mind. And then let's talk about, just kind of breaking this down and just kind of going over. These are some real high level figures here, just to give you an idea of kind of what would be your gain or loss on the property, just going through this. So obviously the selling price, right? A lot of times you know what you're selling your home for, as you would expect. But you are able to reduce that selling price by any expenses. So what are expenses? It could be, realtor commissions. That's usually one of the bigger ones when you're selling your house. And so, essentially selling price less any selling expenses equals, the amount realized from the sale. And then you're able to deduct what's called adjusted basis, which we'll talk a little bit more about. And that equals your gain or your loss. So things that go into adjusted basis would be closing costs from the property that you're selling. So things like title search that you did when you bought the home, recording fees, legal fees, survey fees, recording fees, all those kind of like initial closing costs. Go back to your closing documents, find out what those are, because those can be added in on your adjusted basis. And then things that also, capital improvements that you've done along the way also are going to increase your adjusted basis. And those are essentially improvements that have prolonged the useful life of the property. So things like additions, systems like a furnace, if you put in a furnace, landscaping, fence, walkways, patios, that kind of thing. Exteriors, if you did a new roof, new windows, plumbing, if you put in a water softener, a new septic system. And then on the inside, things, like a kitchen remodel, fireplace, those kinds of things, those would increase your adjusted basis.
Kate, you're highlighting what some people might describe as the nightmare of home ownership, all of the costs that are associated with maintaining and upgrading a home.
I know.
It's one of those never-ending, cycles where you seem like you're always putting some more money into the house, whether it's fixing something, which is different than a capital improvement.
I was going to say, yeah.
Or, listen, we've all seen our fair share of dumpsters in driveways, in our neighborhoods, and certainly that a whole lot of that was happening during the pandemic. And it just seemed, at one point, it seemed like almost like every third driveway had a dumpster going, and people were moving things all over the place. So I would say
we're all stuck at home.
Yeah. So I would say, as we sit here in 2025, this part of the adjusted basis, I think, is a big item for folks to pay attention to, because we know that the amount of spending on home improvement through the pandemic, and then even these last couple of years or so, really got bumped up from recent historical levels prior to that. So a lot of people are in this boat where they know what they paid for the house, and then they put a lot of capital improvements into it, and it's really about making sure that you're keeping track of those receipts and those records, so that you can feel good about using those as your adjusted basis for potential future sale.
Yeah, that's a great point. And so you'd mentioned things that aren't included, and you're right. The annual maintenance of a home can be very high. And a lot of those maintenance items, just kind of like the repairs, the landscaper coming to cut the lawn, that is not a capital improvement. Those items do not adjust your basis. So kind of those repairs, if you have someone coming to, fix the furnace, that's not going to be a capital improvement. If you replace the furnace, that's a capital improvement. So paying attention to those nuances as to what's a capital improvement, what's not. And you're absolutely right, keeping track of it. So let's just go over like a few things that's not included in adjusted basis, just to give everybody kind of an idea of, how to think about this. So things like utilities, right? Kind of part of the living expenses of living in a house, so your electrical bill, your water bill, those items are not included in basis, as well as your moving expenses. Let me tell you, I got some quotes from movers. Movers, it costs a lot of money to have a truck and a bunch of people come to help you move. Yeah. Unfortunately, that's not included in, the basis. I wish it was.
And those quotes, by the way, I'm sure are all over the map. I remember the ones that we got too. It's just, you hear one number from somebody and the other one is not even close.
I know. And my husband was pretty convinced that he could just have a few buddies over and get him a case of beer. And I was like, I don't know if that's going to do it.
Is your husband in his 20s still?
No, nor our friends. So, it's, but yeah, you're right. There were a lot of different quotes. And honestly, it's funny too. I think, once the listing went on, I think we must have been put on an immediate marketing list for movers, because we did get a lot of, we help move. So, kind of mailings. So, and then mortgage expenses, those are not included, as well as any insurance premiums. And again, any improvements that are not going to prolong the useful life of your home. So essentially, anything with a life expectancy under a year, paint, repairs, that kind of thing, are also not included, in that adjusted basis.
We've painted countless rooms over the years, my wife and I.
Have you done it, or have you hired? Hired someone?
We've done it. We've
okay.
I grew up. My folks were DIYers when it came to paint. Right, we weren't a very handy family, but we could paint. And listen, I have a memory of back when I was a kid, we took on the challenge of painting the entire exterior of our house.
Ooh,
and it wasn't even
scraping and all.
No, listen, it wasn't even paint; it was stain. We stained an entire house, a 4-bedroom, 2.5 bath, pretty.
Did you have to sand it down?
I forget those
to get
details.
it down.
I don't think I did.
That must have been the most painful part.
But we were on ladders, and staining is a different animal than paint, and it certainly smells a whole lot different too.
I was just going to say I was having a very olfactory memory just then as you said that. This very vivid smell memory, like of stain.
So we put the work in, but anyway, that translates into people paint rooms and bedrooms and bathrooms and stuff like that all the time. We've done our fair share of that. But that's,
right, and if you're not DIYing it, if you're not DIYing it, listen, that's expensive too. Just having someone come in and paint. If you're handy and you DIY it, great. If you're having somebody come in, it can be a little bit more costly, and that's not a capital improvement, unfortunately.
Residing, if you resided the whole house.
Residing is.
Yeah.
And actually there is, and there actually is one kind of little caveat is, painting might be if it's part of a larger renovation. Mm-hmm. So that's something to look into with your accountant as well. So there, always run this stuff past your CPA and, your tax advisor and your exact situation. But, sometimes painting might be if it's within a larger, project that you're doing.
Well, that's maybe something I should look into because we did some renovation to our house, and we did paint the entire exterior of the house, including the new sections.
Okay.
So that is something that
right. So if you did an addition,
yep.
That kind of thing, look into that, and talk to the CPA about that. And so let's just give an example, right? So this is kind of just a hypothetical. So let's say we have a married filing jointly couple. They bought a house in, let's say, 2018. So right before the pandemic, $600,000. And they've lived there full time since. So they haven't taken this Section 121 within the last 2 years. So they're potentially eligible. They've lived there. They've owned it. So they're eligible. They don't pay PAT taxes. They didn't acquire this property through Section 1031. So let's say again, they bought it for $600,000. They had $5,000 in title fees when they bought the home. This is a very simplified example. They put $100,000 of capital improvements in over the year, roof, new kitchen, fence. So their basis in the home, their adjusted basis, we should say, is $705,000. So now come 2025, we've had this phenomenal home price appreciation through COVID, and now their home sells for $1.2 million. Let's say they paid 4% in realtor commissions. So they, net that out from their sales price. So they net out 1.152 in, net sale. So to figure out their gain, they would take that net selling price of 1.152 less the 705,000 capital gain, the 705 cost basis would be a $447,000 gain. And so this example where they have $447,000 in gain, since they're married filing jointly and they do, potentially qualify for this 121, they would be able to exclude that full $447,000 gain because it's under that $500,000, cap. So this is, what an amazing benefit, right?
Yeah, and this is not an. The example you have here is really not unusual, right? If you think about somebody who bought before pandemic, put some improvements into the house, and then they list it today, right? Anecdotally, I keep hearing examples of sellers getting X over ask, right? Consistently. So in your example here, I think this is not an outlandish, thing that some of our listeners may be, experiencing if they're thinking about putting their house on the market.
Yeah.
You may think that you're subject to some capital gains because you're selling for 1.2, right? And in your head, you keep thinking that you bought the house for 600, and you may not be thinking about the capital improvements, right? How that lifts your cost basis, and also, certainly I guess our job, Kate, is to get Section 121 into the lexicon. Good luck.
That's what we're doing here today.
Good luck with that.
That's what we're doing here today. And
it's not going to be a March Madness type of thing, but maybe one day.
I don't know how we can make this into brackets.
Yeah, no,
I don't know how
I'm talking about
it's not as much
what
fun.
March Madness means.
Oh yeah,
we got to get people thinking 121.
Yeah, I thought I was trying to make this more fun, but yeah. And what I want to point out here too, right? In this example, did you hear me mention anything about a mortgage? No, because mortgage, that does not factor into our calculation here at all. Whether or not you have a mortgage on the property, what you really want to be focusing on is, what you're selling the property for, what you bought it for, your adjusted basis, right? And that net selling figure. And that's how you're going to calculate the gain. And that's really, what's going to come into play with this Section 121.
Good point. I don't think we have an example of where you would get like a gotcha situation. I think, so I know somebody near where I am who's a builder, and there's a methodology where he'll buy, he'll build, and then he'll live in that for the 2-year period, right, to get himself that exemption eligible, then sell to a permanent resident, and then move on to another one that he's already started to build, right? So in terms of sequentially thinking about how you might avoid the 2-year test and not being ineligible if you already took the exemption within the last 2 years, to your earlier point. That's an unusual example, but
no, I think that's a great point. And actually, I wanted to highlight a couple of other thoughts here too. So one, let's just think about this for a sec, right? So remember, this is going to be anything above this $500,000, right? In this example, let's say the couple netted $600,000, gain after they factored in their adjusted basis. In that situation, if you had $600,000 in gain, you'd still be able to take the 500, which would leave $100,000 of gains exposed to potential capital gains tax. But what I want to point out is that, this is a long-term sale here. So this would be a long-term capital gain, right? Because again, this is a property that's been owned for over 1 year. Mm-hmm. So it'd be a long-term capital gain, right? So again, capital gains just is going to be, I can't think of it as an example where capital gains tax is greater than what would be income tax, right? So your income tax bracket. So you are getting a benefit of having that lower capital gains rate for having this gain. So even if your amount is over that capital gains amount, you're still getting that preferential capital gains rate relative to the income tax. Mm-hmm. So let's take your example of your builder friend that has lived in the property. Let's say he lived there for, he doesn't qualify for the Section 121 because he's only lived there for 10 months, right? Yeah. So if he lived there for 10 months and sold the property for a gain, he would be looking at that short-term capital gain. And remember, a short-term capital gain is going to be taxed on ordinary income, which is a higher rate. So his kind of little tax planning thought there might be ... Do I wait 2 more months to get that even better long-term capital gain rate? Right? So that's kind of one thought to have. And then let's say your friend, your builder friend lived there for 16 months. So, okay, he's already got that long-term capital gain, potential sale, but then does he wait the next, 8 months to be able to take, advantage of the Section 121? So again, some tax planning opportunities, even for individuals who don't qualify, I think, for Section 121 because of that, ownership or that ownership or use, test. Still have some tax planning considerations, I think, that you can make. So it's important to review your situation with, your CPA and kind of think about this strategically as well.
Yeah, and for the one you mentioned before, where you may be above the exemption amount, so you got to factor in the tax that will be owed above the full exemption. as part of the entire transaction. So making sure that you're
Yeah.
not blindsided by that is obviously an important.
Yeah. And what I want to mention too is, if you don't qualify for this Section 121, there are some kind of like extraordinary circumstances that do still get maybe a partial exemption. I think there's some, if you're a military personnel that has to go overseas, that kind of thing, or if you have to sell your home because of a new job or a new location, there are some little other possibilities for you to be able to take at least a partial exemption. So I would, again, urge everyone to review the situation and kind of their scenario, with their CPAs to see if there's even a partial exemption that might be available to them.
Good point. Absolutely. This is certainly one of those case by case. You got to keep track of your own situation, your numbers, your situation in terms of the details. So when you're planning, again, I think when it comes to taxes, it's about I think knowing as much as you can up front, so there's no surprises on the back end.
Yeah, and remember, if you do get pushed, if you are, capital gains, if you are pushed into a situation, well, it's a good problem. Again, you have big capital gains, I guess, on your home. Remember, capital gains aren't going to push you necessarily into a higher income bracket, but, they can have a tax impact, right, as we're kind of highlighting here, and also could potentially affect your AGI, which could then potentially affect, other government benefits. It could potentially push you into a higher IRMA bracket, a couple years down the road. So just other things to consider and think about.
It can get a little complicated, but we're hoping this is, a helpful way to think about, potential exemptions for folks out there that are moving like yourself. I
know. So if I look extra tired, that's why. But yeah, no, we're again, wanted to highlight this. I think, again, the housing market has been very strong. And so for individuals faced with a move, we thought this could be really helpful. So, we thank all of our listeners for tuning in. And hopefully this is my last move down the street.
You get to the point where you have to ask yourself, is this the forever home? And even forever just means, especially in my case, it's like
next 10
forever,
years.
Well, it's forever until the youngest is out of the house, right?
Exactly.
And then you're like, okay, where are we going from here?
Exactly.
Yeah. But
exactly.
Hopefully this is the spot for you guys to settle in for the foreseeable future, for sure.
Thank you much. And thanks again for all of our listeners for tuning in. Again, we're Amplified Wealth according to plan. Be sure to like and subscribe, and we'll see you back here soon.
Thank you.